Welcome to the Vest Capital Podcast, the go-to platform for accredited investors, real estate developers, and entrepreneurs seeking to build wealth by investing in private real estate.
Are you not entertained? Are you not entertained?
Every time, every night is a loose one. And every flight, you know that I put the crew on. You say that I drop top, well, and tell me
For the month of July, we will be diving deep in the sector of private equity, particularly the subcategory of the capital stack. The capital stack is primarily comprised of four core elements. We have preferred equity, common equity, mezzanine financing, and senior debt. We're going to take a deep dive into each component and how that impacts the overall deal of the real estate cycle. Let's start with preferred equity. Preferred equity primarily is brought in by accredited investors in the form of cash. This is our down payment contribution to the deal. We also have common equity. Common equity is often contributed by the sponsor. They also get paid after the accredited investor within the capital stack. Then we have mezzanine debt. That is typically secured by the instrument of a deed of trust by a promissory note. They are secured in second lien position of the asset. Then we have primary debt, senior debt. This is typically a larger sum of capital that is then secured by a deed of trust in first lien position by a promissory note. Oftentimes, the lenders will also require either a completion guarantee or a personal guarantee of the actual borrower or the sponsor, and occasionally, depending on the jurisdiction in which you reside, a spousal consent as well for the guarantee aspect of the loan. Now, when it comes to the repayment, the lower the risk the investor takes, the lower they are on the capital stack. The higher they are, the higher risk they take, and the higher potential return on investment will be achieved. It's all proportionate with your risk tolerance as an investor. Where's your comfort level? Where do you want to spread out your risk? And typically, it is underwritten by a deal-by-deal basis. Let's run by an example here at Vest Capital of how we structured the capital stack. We took down a deal several years ago called Columbia Eden. That consisted of a single-family residence that was just rough across the board, and it was the original homestead on 3 acres. The purchase price was $1,150,000. So we were able to negotiate a deal where the seller subordinated to a second position or mezzanine financing for an 18-month duration, bearing 0 interest, and it was not accumulating at any interest rate as well. So it was very favorable for the sponsor, and the lender as well, aka the seller, also had the ability to then be in a secured position for a payout down the road while we worked on our entitlement work. So the $1,150,000 purchase price consisted of the seller subordinating to a second lien position. We brought in $750,000 of senior debt, and then we brought in $250,000 worth of preferred equity. That completed the capital stack upon acquisition. Then we move forward to securing additional preferred equity for the renovations of the house to increase the value of that one parcel. In addition to that, we also brought in preferred equity for all of our entitlement work, which consisted of independent studies from our engineers and our applications to the city to then have this development become approved from raw land with just a house on it to an approved multi-lot subdivision that was an executive level with a very affluent demographic that's going to be acquiring this particular asset. So as you can see, the capital stack is incredibly critical in the success of an overall project. If you bring in too much leverage, there's always a risk that the market pulls back 20, 30%, and you could be at risk with the obligation of servicing debt. That's incredibly important that you don't over leverage on any particular deal. So a good rule of thumb to follow when it comes to land, generally speaking, is 50% loan to value. So for example, if the dirt is worth $10 million, $5 million of that could be in the form of preferred equity. The additional $5 million to complete the deal would be in the form of senior debt, 50% across the board. And then once you acquire the land for that $10 million, you can still proceed forward adding value to that land basis in the form of entitlement work. That's where you have imputed land value over a longer period of time, and you can go ahead and have that dirt reappraised for a higher valuation, and you can take it from dirt to keys ultimately. This is just one key element of the capital stack and how it can impact you as an investor and the developer as you see how it plays out.
That's what I'm constantly summoning. I love the climb, I don't care where the summit is. Funny when people be saying I peaked. Retired, my parents, they live at the beach. Models and freaks is my track record. I made my homies my staff members. Got myself lit to give y'all the light. Using my mind to attract better.